Hi, I'm Amanda Beeslaar, Head of Retirement Products for Aon New Zealand. And today I've got joining me
Alister, Maas, the Managing Director of Russell Investments, again in New Zealand.
Alister. You asked us to join us today to talk about the 7 habits of effective investors. What are they?
So without starting on the points first, investing's hard, right? It's hard for everyone. It's hard if you're an investment professional as well. But there are some things that differentiate a normal investor with effective investors. And one of the first ones is to set a clear objective. It's really important to understand the purpose of your money. Why are you saving? Why are you working? Why are you trying to build up a pool of assets? What's it for? That's probably the most important thing, I think. And when we work with our clients, that's the thing that we spend the most time on, is understanding what's the money actually for.
Okay, great. And what is the second most important point?
One thing that's not appreciated that much is risk. Risk is complex. Risk for an investment professional means the volatility of returns, means how much those returns go up and down. But for mum and dad, it's really hard. And everybody has a very different impression on risk, a different thought process behind it, and it means different things to different people. So what's really important is to understand what risk means for you. There are a whole host of tools around on the internet that can help you work through risk. Aon has one sitting on their website, which is a good one. We have one sitting on our one. But it's important to understand risk because you don't have return without risk.
Before we started, you also spoke about the third option, which was about setting an investment strategy and a plan. What does that mean?
Okay, so broadly speaking, you want to, once you've set your objective, once you understand the risk, then you want to work out how you can get to your objective. For an investment professional, that typically means setting your growth asset and income asset split, but having an understanding of what that will do for you, why you have it, and where you will end up after a period of time. So an example for a plan might be, I'm going to be a moderate investor over the next 20 years, and I'm going to contribute X% of my salary into my savings plan so that I can retire on this much money. Write it down, codify it, understand why you're doing it.
Sounds like a good plan. Now you're talking about understanding what you are investing in. How do you go about that?
Well, as I said earlier, investment's difficult and there's a lot of complicated stuff out there. There's a lot of complicated things going on. I personally think it's really important to understand what you're investing in. What are equities? What are bonds? Why are they different? If you want to invest in shares on the share market, or you want to invest in a private equity asset or some property, what is it? What actually are you ending up investing in? And it doesn't take too long with some good Google searches to find out what you can be investing in.
You talk about private equity. For most people, they won't understand what does private equity mean.
That's right.
So just how do you define asset classes or what you're investing in? Put it in layman's terms so that they can understand.
Broadly speaking, the things that will drive your return over time is the amount of assets that you have invested in the share market shares. Private equity is a type of share, means a direct ownership of a company or of an investment. The other component from equities is fixed interest assets. They can be government issued debt, they can be corporate debt. They tend to be less volatile and therefore also have a lower return than equities.
Okay.
So at a high level, try and understand where your money's going and why you've put it there.
Point number 5 is time is your friend. And you spoke about compounding interest. What does that mean?
Well, look, investment is not a quick game. It's very, very hard to make very quick returns in the investment markets. So what most investors try to do is set a time horizon, 10 years, 20 years, 30 years, set an objective that matches that. So, I want to retire at 65 with this much money. In order to do that, I'm going to have this amount invested in the share market, this amount invested in fixed interest assets. over that time period, each year you'll get a return, hopefully a positive return, but sometimes you might lose some money. That's what investment's about.
Especially in these days. Earlier this year, we learned what that meant.
That's right. So when you get a return on your investment, it gets reinvested back into the same pot. And then you earn a return on that bigger pot. So the longer you can invest, the bigger that extra pot comes. It's not just what we call simple interest, so interest on your main capital principal. It's the interest on the interest. And that actually is every investor's friend.
What I can also take from that is the sooner you start, the better it is.
Absolutely. It's really important to start saving for your retirement, for example, when you start working. If you're saving for a home, if you're saving for a car, if you're saving for a trip overseas, start in advance. It just makes it so much easier. Start a long way before you need the money.
What's the other point or other 2 points that you would like to raise today?
So one of the important things is to just review your investments periodically, not all the time. I wouldn't advocate having it sitting on an app where you can see your balance going up and down on a daily basis, personally. I think every year you maybe have a look at it. Every couple of years at least have a look at it and see how you're tracking relative to the objective you set at the outset. So if you've got 20-year time horizon before retirement and you've said, I need to have this much each year, how are you tracking? And it doesn't mean you have to change what you're doing, but it means you just have to have a look at it. Periodically review it.
Okay.
If it's not matching what your expectations are, you've got a couple of things to do. First of all, you could change your objective because it might not be realistic. For example, it wouldn't be realistic to expect an 8% return on the share markets over the next 10 years now, but 10 years ago you could have expected that. It wouldn't be realistic to expect government bonds to keep on going up and getting positive returns from them. So you just have to check in to see that things are working as you thought they would. And if they're not, then you can make some changes.
You talk about review periodically. Who can assist you with that?
Well, that's where I get to the final point, which is perhaps the most important point, is to get some advice. I think you'd find that most investment professionals will get advice on their personal assets, on their personal investment strategies. For mum and dad, it's really important to do that too. Find a good advisor, spend some time with them, get them to help you build a plan. Using the things we've talked about today, objective setting, how are you going to get there, your time horizon, your risk, review it periodically, and meet periodically with your advisor to see how things are going.
Great. Thanks for joining us today.